So the incredibly anticipated CPI data for February has finally come out, and the stock market is simultaneously starting to reverse in some very critical sectors. We've obviously seen the oil embargo skyrocket gas prices, which has unfortunately further increased most investors' inflation expectations. But if you go out and analyze the basic macroeconomics of commodities and consumer behavior, you'll actually find that this oil crisis might actually help in bringing inflation down in 2022. And if you pair that with the fact that the Federal Reserve has already hinted at being easier with raising interest rates this year, we could be getting much closer to a bottom in the stock market than many people expect. So in this video, I'll be giving you guys a breakdown of the latest CPI report, share the big reasons why some stocks are starting to U-turn, and at the end, I'll analyze the highly talked about possibilities of a recession. But before we get into it, guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. As you guys can see, although yesterday and for the past few days of this week, we've had some very nice green days in small caps and tech stocks, today we're starting to see some selling pressure to the downside because oil prices are starting to stabilize, and we're still not seeing some strong ceasefire talks between Ukraine and Russia. And if you guys have been keeping up with the CPI report that came out this morning, it actually came in right in line with analyst expectations, with a year-over-year growth in prices of around 7.9%. To a certain extent, this is actually a bullish indicator because what it tells you is that analysts are starting to get a better idea as to what exactly is causing inflation in our systemic economy, and it also shows you that inflation might not be running away like many investors and economists have been expecting over the past couple of months. In February, most of the inflation was actually driven by the gasoline index, which is obviously no surprise because oil prices were skyrocketing in anticipation of an invasion by Russia after they gathered all their troops on the border of Ukraine. But I think what many people are not understanding fully right now is the effect of higher oil prices on consumer spending and how that could play into potentially lower inflation over the next couple of quarters. You see, when oil prices go up, the prices of gas and some food items also goes up, and what that can potentially create is a demand destruction scenario where consumers are not willing to pay the higher prices anymore, and that could result in a sudden collapse in commodity prices. Economists have predicted that a 1 penny rise in higher gas prices typically cuts consumer spending across the entire United States by $1.2 billion. And since obviously consumer spending has been the core reason why we've seen so much inflation over the past year, rising oil prices might actually be deflationary for bringing down some of the other indexes that we look at to measure inflation. You see, there are two different indices that we use to measure inflation in this country. One is called the CPI, which is the one that came out today, and the other one is called the PCE, or the Personal Consumption Expenditure Index, which actually often lags the CPI index. And the reason for that is because the PCE does not account for energy and food prices. And the reason for that is very simple, because the Federal Reserve is often going to make monetary policy decisions based on what inflation is doing. And since oil and food prices are so volatile, the Federal Reserve decided that they don't want to make their financial decisions based off such a volatile piece of commodity and price. And so as you can see, CPI often exaggerates the actual inflation metric that the Fed actually uses. And as you can see, the FOMC completely focuses its decision making on the PCE index and not the CPI. And since, like I said, oil prices going higher could potentially create a situation of demand destruction, we could actually see the PCE index start inverting over the next couple of quarters as we see potential consumer demand going down and as we see companies raise prices more aggressively. And so the case that many people have been making over the past month or so about rising oil prices resulting in the Federal Reserve being more aggressive with raising interest rates might not actually fully play out because the Federal Reserve focuses on the core PCE, which obviously excludes gasoline and energy and food prices. Now obviously in the short term, both the PCE and the CPI are still growing at around 40 basis points year over year, but it's going to be very critical as we go into the summer to watch the PCE index, and if it goes down, we could be signaling a potential start of a demand destruction scenario for consumers. And since obviously over the past 6 months, the stock market has been solely focused on the Fed and interest rates, this could play out to create a potential near-term bottom if we start seeing inflation inflect to the downside. And even the CNN Fear and Greed Index is trading at a very low level of around extreme fear, which historically has always been a great buy the dip opportunity. Now obviously you don't want to go all into the market at one point in time because the macroeconomic and the geopolitical situation could definitely change, but you definitely want to take advantage of some of the deals we're seeing in the market right now, because like we saw in March of 2020, the market will turn around on a dime when everybody least expects it. And here's another good illustration of that. As you guys can see, the extreme fear index has always acted as a very good signal of a potential near-term bottom. And right now we're coming down to the levels that we saw happen in March of 2020. And the best part is that right now we're nowhere near a recession scenario like we had in 2020. People are not losing jobs, the labor market is extremely strong, and unemployment is at a record low level. And obviously we're seeing corporate earnings reflect that, with many CEOs raising their guidance for sales and earnings for 2022. Obviously in March of 2020 that was not the case, and we saw a lot of people lose a lot of jobs very fast. So right now this fear is most definitely, in my opinion, not needed. And obviously, as seen by the recently announced Amazon split and $10 billion buyback program, companies and CEOs are realizing that a lot of valuations are still very suppressed in this kind of market, and that corporate outlooks and cash levels are still very strong. And so unless we see inflation run away and the Federal Reserve turn into a very aggressive hawk, we might not see that much more pain throughout 2020, although volatility will definitely still stay. As for addressing the big elephant in the room, which is the chances of a potential recession happening, I personally think that the Federal Reserve has a very low conviction to actually rug pull us and raise interest rates extremely aggressively to well over 2% by the end of this year. And the reason for that is since Europe is obviously very close to potentially going into a recession because of their very high dependence on oil imports from Russia, we could see the US dollar actually retain its strength as compared to some of the other European currencies. And obviously, since the entire reason why the Fed is fighting inflation is to preserve the strength of the US dollar, that might actually play into the hands of a potentially more dovish Fed. And obviously that's a little bit more of an aggressive take, but I definitely think it pays to look at some of the tailwinds we're seeing in the economy and some of the more macroeconomic factors when we have so much fear from retail investors and even a lot of hedge funds and banks in this macroeconomic environment. If we now move on over to the stock charts and address the big question on everybody's mind, which is answering when will the stock market see some sort of relaxation and a potential near-term bottom, as you guys can see, the S&P 500 index that I have up here is clearly showing signs of a very aggressive downtrend in the short term. And as you guys can see, over the past 5 years, whenever we have seen these aggressive pullbacks, we've always seen some very aggressive moves to the upside, although in the short term, it looks like the market is never gonna recover. And so although I do see some downside in the short term to around this $391 level at that 100-week moving average, if we somehow break below that 415 level, I'm still taking advantage of some of these dips, because as we've seen over the past couple of years, whenever we have these very strong geopolitical situations, they've always been priced out of the market within the next 16 to 18 months. If we move over to the Russell 2000, which is a small cap index, we are definitely seeing a lot of relative strength as compared to the S&P 500. And the reason for that is pretty simple, and that's because of the fact that the Russell 2000 has been in a bear to sideways market ever since the start of 2021, whereas the S&P 500 obviously had a very good year in 2021. So people are clearly seeing a lot of deals in small cap stocks right now instead of some of the bigger cap stocks like Google, Apple, and Microsoft. If we see any pullback on the IWM index to around this $190 level, I would definitely be a buyer. And if we see a potential breakdown below 187, we definitely have a little bit of downside to around this $171 level, which is right where we had this massive gap during the election. But if you look at the RSI on the weekly time frame, we're definitely trading very cheap, which means that generally speaking, you're getting a very good deal if you're starting to invest in the market right now. And obviously, since inflation is so high, people want to own assets, and you're definitely not going to get any return investing in bonds right now. But anyways guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below your guys' thoughts on the CPI report, the situation of inflation, and a potential recession happening in 2022. But anyways guys, I hope you enjoyed this video, and I'll catch you guys in the next one. Take care.